an active or a passive investment philosophy in mutual funds. The idea of philosophy behind investment is to beat a certain benchmark, for instance, inflation, and to create an alpha over and above the said benchmark. Passive funds are those that are designed to track the index by investing in the same stock as the indices. So, for instance, a Nifty 50 based index fund will have its holding and weights similar to the stock composition of Nifty 50. For instance, if we take Nifty 50 and the top 10 stocks within the index has a approximate 57.7% weightage, then out of the total 50 stocks, the performance of the index fund will also have the same kind of skewness in its holding and thus a direct impact in its return. Whereas in case of an active fund, the fund manager has the autonomy to pick stocks which would help them get the best possible returns and at the same time manage the risk or the downside. By this logic, usually we would believe that the active fund managers would be able to outperform the index or the passive funds. However, let us understand if that's the case at all times. Now, how exactly have the active funds performed in terms of their counterparts? In the last 10 years, on an average, 80% of the open-ended, actively managed, diversified equity funds have created an alpha, with an exception of the year 2018 and 19, where only 2% and the 22% of the entire universe generated an alpha over the counterparts. These years were exceptions because of three major reasons. First is the movement of Nifty was contracted. That is, only 5% of the stocks that had a weightage contributed to almost 214% of the returns. This showed that the rally was very concentrated, which we did not really see in the past. So if any active fund manager had an exposure of less than about 30% of an allocation, they witnessed negative alphas because of this concentrated rally. Mid caps underperformed hugely to large cap, which has been at a 12-year high. And then SEBI had a mandate to recategorize funds. However, as the time period increases and the markets go through various cycles, providing an alpha generating opportunities to fund manager. Underperformance for a short period of time could not really be construed in order to make a long-term investment decision or in order to understand and streamline investment approach followed by active fund managers. The investment decision in a mutual fund should solely depend on your risk preference and investment goal. That is, your objective, your risk-taking capabilities, and the tenure at which you're looking at investments should be your prior and primary goal before investments. Index funds are ideal for investors who are really risk averse and want returns in line as a benchmark. These funds will give you returns matching the upside and the downside of the particular benchmark. Investors should look at investment decision basis their objective. It's their objective combined with the risk-taking capabilities along with the time horizon that should be the basis of their financial strategy. So, for instance, an investor with a moderately aggressive risk-taking capabilities would be able to generate an alpha of about 8.1% vis-a-vis Nifty in the last 3 years. That is a CAGR of almost 22.4% if they had invested in the Anand Rathi well-researched, actively modeled portfolio. Thus, investors can look at a good recommended fund and not keep biases towards active or passive funds for their investment needs and risk profile. Investment strategy alone should be the driving factor for an investor. Investors can also go check out the other baskets as per their risk-taking tenure and capabilities in the Anand Rathi Mutual Fund app.
Anand Rathi Share and Stock Brokers Limited AMFI registered mutual fund distributor. ARN 4478 mutual fund investments are subject to market risks. Read all scheme related documents carefully before investing.